There's a strange moment almost every trader experiences. You study the chart. You wait patiently. You identify a clean setup. You calculate your risk. You place your stop loss exactly where it should be. Then the market moves straight toward it. Your stop gets hit. A few minutes later, the price reverses. It travels exactly in the direction you originally predicted. And suddenly, one thought appears almost automatically. There's no way that's a coincidence. Maybe the market can see your stop. Maybe the brokers are hunting it. Maybe someone bigger always knows where retail traders place their orders. After enough experiences like this, it stops feeling random. It starts feeling personal. Not because you actually believe the market knows who you are, but because your brain begins treating repeated disappointment as intentional behavior. And that's the hidden truth behind this entire experience. The market isn't attacking your stop loss.
Your brain is turning randomness into a story. Understanding why it does that changes much more than your trading. It changes how you understand uncertainty itself. Because this isn't really a lesson about stop losses. It's a lesson about how the human mind reacts when reality refuses to behave like a fair opponent. Imagine walking through a forest. A branch suddenly snaps behind you. Your ancestors couldn't afford to assume it was just the wind. If they guessed wrong, they disappeared from history. So evolution rewarded a brain that constantly searched for intention. Was something hunting me? Was someone watching me? Was there a predator nearby? Notice something important. The brain doesn't begin with randomness. It begins with agency. It assumes someone or something caused the event. That instinct kept humans alive. But financial markets are completely different environments. Markets don't possess intention. They don't know your account exists. They don't recognize your emotions. They don't celebrate when you lose. And yet, your ancient survival system keeps asking the wrong question. Who did this to me? Instead of asking, what happened inside a system of millions of independent decisions? That's a completely different question. One creates frustration. The other creates understanding. Think about how quickly the story forms. Your stop gets hit. Price reverses. Within seconds, your mind begins collecting evidence. This always happens. Every time I move my stop, it goes there first. Someone is definitely targeting retail traders. What's fascinating isn't that these thoughts appear, it's that they feel completely reasonable. The brain isn't trying to deceive you, it's trying to reduce uncertainty. Humans dislike unanswered questions. When something painful happens without a clear explanation, the mind invents one. Sometimes that explanation is accurate. Sometimes it's simply emotionally satisfying. The explanation that hurts the least often wins. Because saying, the market is unfair, feels easier than saying, randomness sometimes looks incredibly personal. This leads us to what I call the spotlight illusion. Imagine standing alone on a dark stage. A single spotlight follows you everywhere. After a while, it becomes impossible not to feel like you're the center of the performance. Trading creates the same illusion. Every candle feels connected to your position. Every movement seems to respond to your decisions. Every loss feels like evidence. But here's the reality. You're standing in a stadium with millions of other participants. Banks, institutions, algorithms, market makers, hedge funds, long-term investors, short-term scalpers, corporations exchanging currencies, governments adjusting reserves, commodity producers hedging future prices. Most of them have no idea you exist. Yet your mind compresses this unimaginable complexity into a tiny personal movie starring one character, you. That's not arrogance. It's simply how human perception works. We experience life from inside our own perspective. So our brain naturally exaggerates our importance inside systems that are actually indifferent. Now, does that mean stop hunting never happens? Not exactly. Large pools of liquidity absolutely exist. Professional participants often know where clusters of stop orders are likely to accumulate. Not because they know your account, but because human behavior is remarkably predictable. If thousands of traders learn the same textbook support level, many will place stops in nearly identical locations. That creates liquidity. Large participants sometimes move through those areas because liquidity allows large orders to be executed efficiently. Notice the difference. The market isn't targeting you. It's responding to order concentration. That's a crucial distinction. Imagine rainwater flowing downhill. The water isn't chasing one particular leaf, it's simply following gravity. If your leaf happens to be in that path, it feels personal from the leaf's perspective. But gravity never knew the leaf existed. Liquidity works similarly. Large orders move toward available liquidity. Your stop may be inside that area, but it isn't special. It's simply nearby. Understanding this removes an invisible emotional burden.
You stop interpreting every stopped-out trade as evidence of persecution. Instead, you begin asking better questions. Was my stop placed where everyone else's probably was? Did I choose the obvious location? Was volatility expanding? Those questions improve your trading. The earlier questions only increased your frustration. Here's another fascinating pattern. Suppose your stop survives. Price continues upward. You make a profitable trade. How often do you think,
The market intentionally avoided my stop today? Almost never. When outcomes help us, we rarely assign intention. When outcomes hurt us, intention suddenly becomes obvious. Psychologists sometimes describe this tendency as our search for meaningful causes after negative outcomes. Losses demand explanations. Wins often don't. That's why a stopped-out trade stays in memory far longer than an ordinary winner. Negative experiences leave deeper psychological footprints. Not because they're more common, because they're more emotionally expensive. Your memory becomes an accountant that records losses in bold ink while profitable randomness fades into the background. Eventually, your own memory starts convincing you that stop hunts happen constantly. Not because they do, but because your brain archived only the emotionally charged examples. Now, here's where everything becomes even more interesting. The feeling that the market is attacking your stop loss isn't actually about the stop loss. It's about expectation. Before you entered the trade, you silently made a prediction. If price reaches this level, my idea is wrong. That stop doesn't only protect your capital, it protects your identity as a decision maker. So when price reaches it, the market isn't merely closing your position. It's challenging a belief you held only moments earlier. And human beings naturally resist having their beliefs disproven. Not because they're irrational, because certainty feels safe. Uncertainty feels exposed. That realization leads us to a much deeper question. If the market isn't attacking your stop, why does being proven wrong feel so intensely personal? Because the real battle isn't happening on the chart. It's happening between your expectations and reality. Here's a thought experiment. Imagine two traders taking exactly the same setup. They enter at the same price. They use the same position size. They place identical stop losses. Both are stopped out. 10 minutes later, the market reverses and reaches their original target. Objectively, the event is identical, but their interpretations couldn't be more different. The first trader says, "I knew it, they're hunting my stops again." The second trader says, "Interesting, my stop was probably sitting inside a liquidity pocket. I need to rethink where invalidation truly begins." The market gave both traders the same experience, but only one of them gained useful information. That difference reveals another hidden pattern. Events rarely shape traders as much as the stories attached to those events. Every trade leaves behind two outcomes, a financial outcome and a psychological outcome. The financial outcome lasts seconds. The psychological outcome can influence hundreds of future decisions. If you believe the market is personally targeting you, every new trade carries invisible emotional baggage. You hesitate when you should execute. You widen stops because you expect another hunt. You move stops farther away, hoping to escape the invisible enemy. Ironically, that decision often increases losses instead of reducing them. Without realizing it, you're no longer trading the market, you're trading a story. This is why experienced traders often speak less about prediction and more about invalidation. Most beginners place a stop where they hope price won't go. Professionals try to place a stop where their original idea genuinely stops making sense. Those two locations are not always the same. Hope asks, "Where can I avoid getting stopped?" Understanding asks, "At what point is my reason for entering no longer valid?" That small shift changes everything. A stop loss isn't a wall protecting your ego. It's a line separating one idea from another. Think of a scientist running an experiment. If the results contradict the hypothesis, the scientist doesn't accuse reality of cheating. Reality simply provided new information. Markets operate the same way. Every stop loss is feedback, not an insult, not revenge, not punishment. Feedback. The moment you begin treating stopped-out trades as information instead of betrayal, your emotional relationship with trading starts changing. There's another mental model that's worth remembering. I call it the lighthouse illusion. Imagine you're sailing through heavy fog. Far away, you see a lighthouse. Every few seconds, its beam sweeps across the ocean. If the light lands on your boat several times in a row, it can feel as though it's following you. But the lighthouse isn't tracking you. It's rotating exactly as it always has. You're simply passing through its pattern. Financial markets often feel similar. Volatility expands, liquidity gets taken, price revisits areas of heavy orders. None of these movements exist because of your trade. You happen to be moving through a system that's operating according to its own structure.
The beam crossed your path. It wasn't searching for your boat. This perspective removes something surprisingly heavy. It removes unnecessary self-importance, and that's actually freeing. Because if the market isn't focused on you, then every loss becomes less personal. And when losses become less personal, decisions become more rational. Centuries ago, sailors believed storms were signs of angry gods. The storms felt intentional because humans naturally searched for purpose behind unpredictable events. As our understanding of weather improved, storms didn't become less dangerous, they simply became less personal. No sailor today believes the ocean singled out one particular ship because it was offended. We understand pressure systems, wind patterns, and temperature differences. Knowledge replaced mythology. Trading often follows the same journey. At first, every sharp reversal feels personal. Eventually, you begin seeing liquidity, volatility, market participation, news reactions, and probability instead of invisible enemies. The market hasn't changed, your explanation has, and better explanations usually create better decisions. This doesn't mean you should blindly accept every stop placement, far from it. Sometimes your stop really is too obvious. Sometimes market volatility genuinely requires more room. Sometimes your position size forces you into unrealistic stop locations. Sometimes the trade itself wasn't worth taking. Those are technical questions. They're valuable because they're testable. But notice the difference. My stop placement needs improvement is a useful hypothesis. The market is attacking me is almost impossible to test objectively. One creates progress, the other creates helplessness. Good traders become investigators, not victims. Every stopped-out trade becomes evidence to examine rather than a crime to solve. So the next time your stop gets hit and the market immediately reverses, pause before telling yourself the familiar story. Ask a different question. What explanation requires the fewest assumptions? Did millions of market participants unknowingly interact inside a complex system? Or did an unimaginably large financial marketplace pause its global activity to remove one position from your account? The answer may seem obvious when stated that way, yet in the heat of the moment, our emotions often whisper something entirely different. That's why understanding matters more than motivation. Because motivation fades with the next losing streak. Understanding stays. The market isn't trying to embarrass you. It isn't testing your patience. It isn't rewarding or punishing your behavior. It's doing something both less comforting and more liberating. It's simply being a market. And perhaps that's the quiet realization hiding behind this entire topic. The day you stop believing the market is reacting to you is often the day you finally begin reacting appropriately to it. That shift doesn't just change how you place your stop loss, it changes the role you play in every trade that follows. Instead of becoming the main character in an imaginary battle, you become a thoughtful observer inside a complex system, and observers usually make better decisions than victims. Because the market was never your enemy. It was simply the mirror reflecting how you interpret uncertainty.